Markets nearing the end of its most volatile week of 2024. Investors keeping an eye on what could cause stocks to tumble again at a moment's notice. And one of those catalysts appears to be the U.S. presidential election. For more on how to play the markets ahead of a busy November, we've got Tony Zipparro, who is the EquitySet CEO, joining us here in studio. Good to see you once again here, Tony.
Great to see you.
And so, we're a couple months off.
Yes.
But political talk, campaigning, ramping up fast and furious. You've got one former president saying that he should have an eye into what the Fed is doing, and all of this is going to lead into November, which has already been looked at by many CEOs as what's going to be a very vitriolic election season. What are the best way that investors can stay a step ahead of the campaign talk, rhetoric, and debates even?
Definitely. I think there's a couple variables in terms of definitely recession, market softening, right? That's a big one, and I think that could overshadow the election. But if we're looking directly on themes and kind of motifs we can pull out of elections, I think you look for the overlap, the Venn diagram of what is to avoid or consider in either candidate's case. And so when you look at policies, I think a big thing, you look at domestic, right? And whether it's production, manufacturing, selling, and you look at innovation. And I think you take those and you can kind of sprinkle it through any sector you want to look for good finds, right? Or finds that may be positioned poorly, right? Based on what the policy comes to be.
Does this mean picking individual winners and losers, or are you looking across sector and saying it's better to hold the basket?
I think it's picking individual winners and losers, right? Diversifying a bit, picking a couple, right? And not just putting all your eggs in one basket there. But then it's also going across sector with those individual, right, picks that you do. While certain sectors, right, might be a little bit more exposed, right? Consumer discretionary, some of those names, a little bit of a mixed bag. Risk reward, right, is up there in number versus when you look at consumer staples, right, you can pick maybe a little bit less volatile names.
So let's go into some of those sectors that we had just mentioned for our viewers there. And let's start with energy there. Who are some of the winners, losers that you're keeping tabs on?
So, of course, traditional oil, right? If you look at Harris and renewability and crackdown, right, it doesn't necessarily look good for traditional oil versus, right, Trump, obviously renewable camp, traditional oil. And so that's where I think you go in and you play those two themes I mentioned in the beginning, right, domestic and innovation. And so you can still go into, I believe, big traditional oil companies like Chevron, right, NextEra, Dominion, as long as they're being innovative and have already started the process of renewable energy initiatives, I think you can go there, right? And I think then, of course, EVs, you can dabble a bit, right? And it's all about valuation. Tesla, but at the right number. And so because of all the moves we had, going up near 300, now, sub 200, right? And a lot of these names up 10, 20% in the course of a week. That's where I think you overlay it. And then you avoid the ones that really haven't made a footprint or, again, just aren't really domestically founded.
And then on the other that we were discussing a moment ago, technology in that sector. I mean, a massive pullback over the course of this week that we saw, and some picking and choosing that investors are trying to chart as they decide where it seems like an opportunity to get back in at discount prices, if you will. Not bargain basement, but certainly off of some of the high valuations that we had seen before.
Yeah, and if you would have asked me 3 weeks ago, I would have said, probably don't touch semis at all. But even, right, the moves that we've seen, it's okay, I call it nibbling, right? You can get a little bit, right, because they're not so crazy forward PEs, even active PEs that we're looking at. And so I think technology, the big thing is semis, how does an election impact it? It's really, again, looking at domestic. Most semis have a large exposure to international supply chain, production, manufacturing, something. And so that's where I think you look at innovation. Because the domestic picture isn't as clear. You're not going to get it as, oh, hey, there's these 5 companies I can choose from that are only in the U.S. That's where I think the NVIDIAs, right, the AMDs might edge out things like the Intels and the Microns, just because they're going to move faster than the others and let that disrupt them less.
I'm looking at some of the earnings reports that we have coming out next week as well, and you've got a lot of consumer discretionary names. When you think about how we should be evaluating that sector, not even just for the next earnings or this current earnings period that they're going to be reporting for, but looking out into the back half of the year as well.
And when you get into the consumer discretionary, that's where I think it's more of a roll of a dice, right? Because I do believe we're softening, right? Not the sky isn't falling, but I think a lot of those names will be taken down. And so I think it's buying into those that are domestic, right? Are about home improvement. They might be the Home Depots, the Lowe's, or manufacture and produce more in the U.S. Columbia, right? Sportswear, Deckers, Yeti, and staying.
Yeti, interesting. Yeah. Okay.
And so staying away from maybe some of the ones that have larger international risks, right? And again, you're looking at almost every apparel manufacturer. Yeah. So despite innovation, right, and things we've talked about in the past of like Lululemon, Under Armour, Nike, Gap, Ralph Lauren, I think you stay away from those, but maybe because the unknown is too great in that market.
What do we expect? And there's always this interesting thought process that investors have to wade through every 4 years when we get into a general election of beyond the themes that we could hear discussed, what the real economy will look and feel like as carried through and correlated to the stock market activity. I mean, what is the typical response that we see after election or post-election? And then what really takes the cake from there in terms of investors' eyes? Because it's really been a market driven by two themes. It's been the Fed, and it's also been generative AI. And it seems like one is fading a little bit, and the Fed is finally getting towards their rate cutting.
And I honestly feel that the election, it will create short-term pops and falls. But what I'm concerned about, or what I'm focused on, is the economy's floating. And I think it's floating, and what hasn't been paid enough attention to is debt levels, health of the consumer. And I think it's very healthy for some and not healthy for a lot. And that's where I think that will take focus. And I think there'll be some cracks and then some breaks in the system over the next year or two, which that's why I'm not focused so heavily on what do I invest in from an election, right, and a policy standpoint, because I'm more worried about the financial stability of credit markets and loans and refinancing, even if they cut 75 basis points in September, right, or something, crazy like that. And so I'm worried about that state of the economy more than the election itself.
Tony, I should say, great to see you. Tony Zipparro, who's the EquitySet CEO, joining us here on set.